Okay, so let's just continue the examples here on the cloud. Okay, this is the GitHub example. Down below here, okay, you can also find your own function to find the minimum variance for a specified rate of return. Uh, just like I said, I just use some examples from the reference book from the internet, but you can find so many examples out there from the internet. So don't worry about this, because you can find many uh, cases or case studies either from the books or from the internet, okay, or website. So it's not that important right now, but I think the more interesting thing is that, okay, maybe you can create a function of yours. Okay, you can create a function so that you may you can repetitively use the example in the future. But this is following the same structure, so I'm not gonna give you a review of this function, because most of the formulas and calculations are very similar to the previous examples I mentioned. So you can see we have a z dot mat, okay, and finally we can calculate the mu and the sigma. But the final thing is that I'm using a list, okay, to combine these three together. Okay, so in other words, if I run this again here, okay, I run this again, okay. Okay, and finally you can run this example directly, and you will see, okay, the output of this function, including three parts. The first is weight. Second is a portfolio return. The third is standard deviation of the portfolio. Okay, so this is the example about how to find the MVP for given rate of return. And then we also have many functions provided by the R packages. Okay, so the first one is about the quadplug. So this package also provides some great functions to find the MVP for given portfolio return. Okay, so for this part, we are talking about the quadratic programming. Okay, but the quadratic programming is more advanced techniques in finding the optimal values from our quadratic problems. So I also provided some reference here. Usually, what we are talking about is to use Lagrangian approach, okay, to find the optimal values. So behind the quadratic programming, actually what we are doing is to creating a Lagrangian function, and we try to find the optimized values from this function. So I'm gonna skip this because we can do this completely using the codings, and we can find the answer directly. Okay, so I'm gonna skip this, but if you are interested in this derivation, you can try to do it by yourself. So I also provided, okay, so let's go to the codings here. Here, okay. So what we are doing here is the key function here is called the solve.qp. Okay, solve.qp. So I have D matrix. We also have D vector. Also, we have A matrix. We also have B vector. Also, we have MEQ. I remember I have a slides about this section. Okay, but if you can check out this one, we can just Just a minute. I posted the slides before about the just a minute. Okay. I just want to make sure if this slides is available to you. Okay, it's not here. It's not here. It's not here. Okay. I'll give you the slides later. I don't have these slides for you right now, but it's in my computer. So I'll give you later. But anyway, this is about the Lagrangian function. Okay, so what we are doing here is to use a quadratic programming. We do have some formulas. Okay, so basically you just follow this formula. Okay, and then we have so basically we have a sigma. We still have to provide the sigma. We also have to provide the mu. We also have to provide the A matrix and the mu p. Okay, and of course including B vector, etc. So you can follow this function setup, parameter setup, and then you can derive the results. Okay, so based on this, we can derive we can get the same solution to the weights here. Okay, so this is about the quadratic programming. Okay. Okay, and then based on this, but this is not that important right now, okay? Because in the future, if we like to include more constraints in our investment, for example, maybe we like to put more conditions on our investment weightings. For example, you can require no short sales in our portfolio investment. In other words, all weightings should be positive, or maybe we can restrict some weightings to be within certain to be lie within lie between some range. Okay, for example, like you probably have to invest in Apple Computer. Okay, with a minimum weighting of 20%. Okay, and of course you can also limit your maximum weighting to Apple Computer to 50%, for example. Okay, if you like to do this, you can set up your constraint or conditions in your portfolio construction. Okay, but right now we can move a little bit further to create a frontier function. So in this case, we can generate as many MVP as possible. So now we are creating a function. This is a function we're creating, and then we can plot the results. So let me just run this. Okay, so this is a very original or very rough plotting of the efficient frontier. Okay, so you can see y-axis is return, x-axis is standard deviation. So this is about the efficient frontier. Okay, but this is not very clear because we haven't plotted the 3 asset returns and standard deviation. So we can add a little bit more. Okay, so I also provided some more plugins in the following. But before doing that, let me just jump a little bit further to a different package we call the F portfolio. So just like I mentioned, there are so many, at least three packages in R to help you to calculate the efficient frontier or MVP. So this is second one. Okay, the first one is Waterflow. Okay, the second one is AppPortfolio. Of course, the third one is Performance Analytics, or TS, or time series package, can also help you to do the calculation. But never mind, we don't have to worry so much about this package. Okay, so this is about the portfolio and portfolio. So in the following, I also provided some examples for you to plot, okay, to generate plottings. But right now, I'm not asking you to dig into these packages, because just like I mentioned, all you have to know is to understand the basic theorem behind this data. Okay, so what is the MVP, what is GMVP, etc. Okay, so you have to understand the basic concept. But for this part, it's a little bit more about the quantitative finance. Okay, quantitative finance. It will be a little bit more complicated. Okay, so let me just run this package and try to give you output here. Okay, so when you try to run this package, AppPortfolio, sometimes you have to pay attention to the bugs in your codings. Or maybe when you, of course, most of the time when you run R codings, you will always have bugs or warnings or messages down below in your console. So sometimes you have to check out the problems. Okay, so for example, in this case, why do I have to transform the data into time series data? Because this is required by the AppPortfolio package. So now I'm using time series. Okay, so you can see here, let's check out the class of the time series. Okay, now you can see when I check out the class of ret.ts, because now I'm using time series, okay, function to convert the return into time series data. Okay, so we call this as a time series. So when you use class function to check out the class of the object or variables, you will see it shows the time series. Okay, so but this time series is different from the XTS package. So remember here in the beginning, I mentioned there's a way to convert your data into time series data, right? In this case, we are using the package called XTS. XTS. So this is a different format for time series data in R. So sometimes you have to be careful of the format you are using. Different format belongs to different package. Okay, but of course, it may seem very confusing to you, but sometimes if you want to use specific function provided by this package, then you have to follow the rules required by this package. So for example, now why we have to convert the data into time series object instead of XTS object, because we're gonna use the function provided by the AppPortfolio. So that's the reason why we need to do that. Otherwise, you won't be able to use the function here. Okay, so what we are doing here is to use the package called AppPortfolio, because we want to generate the plot. That's it. Okay, so we just, but of course, first of all, we are going to use the chart cumulated returns, okay, to generate the results. Okay, now you can see the performance of three stocks. So Nordstrom, Starbucks, and Microsoft. So this is the charting for the cumulative returns from 1995 to 2000. So you can see the performance of these three stocks, okay, based on their returns. Okay, so this is one interesting function to generate the cumulative returns. Okay, and then we also have a function called the portfolio frontier. Okay, so portfolio frontier can generate the frontier immediately for you, so you don't have to write a function by yourself. Okay, the interesting thing is that, okay, now you're gonna see 8 options. So the first option is to plot efficient frontier. So let's press 1 here. And then you're gonna see here, okay, we have a efficient frontier being generated. And then we can also add the minimum risk portfolio. So I will select 2. And then you can see that there's a red point here. Okay, red dot here is demands it refers to the minimum balance portfolio. And then we can also add a tangency portfolio. So now I'm gonna press 3. Okay, so we have a tangency portfolio here. Okay, so you can see here, and then you can also press 4 to add risk return of a single asset. Okay, you can. There's a yellow point here. There's a purple point. Okay, purple box here. Okay, you can see here. This refers to the as single assets, and then 5 it refers to equal weight portfolio. Okay, you can see here. So this is a box. Okay, square box. A blue square box refers to the equal weight portfolio. And 6 is about the add to asset frontier. Okay. And 7 is referring to Monte Carlo portfolios. You can generate as many portfolios as possible. Now, portfolio space here. And then 8 is 8 Sharpe ratio. Okay, so this is Sharpe ratio. But this is just some available function for you to see the results immediately. What I like you to do is to understand the logic behind these plottings. So this is not that interesting. So in the following, I will show you how to plot this efficient frontier by yourself. Okay, so in the following, I'm gonna skip that part. And if you're interested in this section, you can try to run these codings. Okay, but right now, this is not the most urgent issue for you, so you can skip this part. So I'm gonna skip that, and we'll go to the tangency portfolio. Okay, because in your homework, I'm also asking you to find the tangency portfolio. For the tangency portfolio, it's also very straightforward. You can also go to the slides to find the formula. Okay, so I've show you here. Okay, so for the tangency portfolio, we can just follow this formula. We call this as a capital allocation line. So you can use T Actually, T is the tangency portfolio. So you can use this formula to find the solution. Okay, so what we are doing here is also to use the Lagrangian function to find the optimal values for the weighting. So T actually is referring to the tangency portfolio weightings. Okay, so you can follow this and then you can find the solution. So I'm gonna skip this codings because all these codings are following the same way of the matrix construction, and you can just plug in the data into the formula and then you can find the solution here. Okay, and then you can find the Sharpe ratio. Okay. Okay, so let me run this first. So tangency portfolio here. Tangency portfolio here is to run this. Okay. Oh, okay. Okay, so finally, the tangency portfolio, the Sharpe ratio for the tangency portfolio is 0.457. Okay, you can verify this value. And then we also have another problem about the plotting because we need to construct the plotting by ourselves. So I also provided some codings for your reference. But let me show you here. We have okay. So first of all, we are using the quadplug to generate as many efficient frontier points as possible, or generate as many MVP portfolio as possible for a given rate of return. So now what we are doing here is to specify the portfolio return. So this case, we are generating 300 possible given returns because we want to generate 300 points. So this is a function called sequence starting from 0.01 until 0.08. The length is 300. So the purpose is to generate 300 specified or given portfolio returns. So based on these given portfolio returns, we can find 300 MVP portfolios. Okay, so based on this data, we can plot the results, okay, and generate the efficient frontier. So in the following, I'm using a looping. Okay, so this is a very standard looping in R coding. Okay, so basically this function solve.qp is the same as the one we used before in previous section here. Okay, so you don't have to worry too much. The only difference is that, okay, we are storing the result, okay, in our STT vector. This is a standard deviation, okay, and this is the weighting. Okay, we have a result here. If you don't understand, we can go back to the quadplug. Okay. Remember the result here. So this is MVP for given portfolio return because now we are using the solve.qp and we'll get the result. Okay. So let's see what we got here. Okay, so let's see what we got here. Result. Okay, now you can see the result. If you check the result, you can see the first is solution. Okay, the solution is the weighting for the three assets. Okay. And also we have values. Okay. So the values, you can see the values is a standard deviation. Okay, standard deviation of the portfolio. Okay, so that refers to the standard deviation 0.00937. Okay, so this is the standard deviation. And then you can also see some other values being generated, because in this case we have two Lagrangian. So the value Lagrangian was also generated. So this is lambda 1, this is lambda 2. Okay. But now we don't need these two values right now. Okay, we don't need this. So we can just focus on the first two values being generated. The first is the weightings, okay, which is the solution. The second is the value, which is the standard deviation of the portfolio. Okay, so based on this, we can move on to the looping function here. So now you can see we are trying to find 300 MVP, okay, MVP for a given 300 sets of portfolio returns. So we can see here, okay, based on this, we can run this part. So let's run this part here. Okay, after we run this part, we'll get the weightings and standard deviation of the portfolio. Okay, and down below here is a big chunk of codings to generate the plottings. And then after you run these codings, the output will be saved in the PDF file. Okay, so this first line is PDF. This is the file name. Okay, you can specify the file name here. This is PDF output, and then you can start your plotting. Okay, so let's just run this real quick. Don't be afraid of these codings, because it's not that difficult. But if you are not really familiar with the plottings, that's fine. The only purpose is to help you to understand what is going on behind this plotting. Okay, in case some days in the future you need to do some plotting by yourself, but don't worry, because now we have AI to help us. Okay, so don't get yourself stuck in these complicated codings. Okay, because it totally up to you. If you like to understand a little bit more about the codings, then you can spend more time in codings. Okay, but if you really don't like codings, okay, then you have to pay money, okay, to buy the codings. Okay, or you can seek help from the AI. Okay, because your AI can help you to do that, no, without any problem. Okay, but the problem is that sometimes if you want to generate your own customized trading strategy, you still need to know a little bit about how to modify the codings to fit your needs. Okay, so this is another problem you need to think about it. Okay, so now I'm trying to run this block of codings. Okay, now you can see好，OK，你也在呃now you can see we have 3 companies here. Okay, Nordstrom, Starbucks, and Microsoft. And then you can see this is a straight line. Okay, and this is the straight line, and we can also see this is GMVP. Okay, GMVP. We also have a tangent portfolio here. Okay, so basically this is the tangency portfolio line and minimum variance portfolio line. Okay, so this is about the final result. So we have 3 portfolios here: Nordstrom, Starbucks, and Microsoft. And we have a minimum variance portfolio, and this is the uh, market of efficient frontier. Okay, so this is the market value, market portfolio. Okay, okay, so this is the codings. Okay, so this part is for your reference. It's just for your reference. Okay, so it's not that difficult. Okay, in the following is referring to no short sales constraints. Okay, but we'll get this. We'll talk about this later. Okay, so what we like to do is to use this function. Okay. Okay, so following is another package called the SIT package, but we'll talk about this maybe later. Let's go to our homework. So what I like you to do is to just a minute. Okay, so this is your homework here. Okay, so the homework here is to use the myETF4.csv. Okay, so the question 1 is to find the GMVP for 4 Taiwan ETF. Okay, so this is the first one. And then because the first one question is based on the daily data, so the second question is you have to convert the data into monthly data and calculate returns, calculate the MVP here. Okay, and similarly you have to calculate the tangency portfolio based on Q2. Okay, so let's go to the question homework here. Okay, so just a minute. Okay, so this is about the homework using the attached file myetf4.csv to answer the following question. So let's see. First of all, I'm gonna show you the some solutions, okay, to this question, just for your reference. So first of all, I just load up some packages, okay? So the first one is readr, and then tidyverse, and then performance analytics, and the time TK. Okay, so this is just for your reference here. Okay, so there's many ways to import the data, so it's totally up to you. Okay, well, I don't require you to have any specific way to import the data. Okay, so you can use any functions you like to import the data. But the first thing is that you have to know how to import the data into your R. And based on the imported data, you can do some calculation. So I just give you some examples, okay? So first of all, we can use the R read underscore CSV, okay? So this is one function, okay? Read underscore CSV. Of course, you can also use read.csv. Okay, no problem. Okay, because we can use either one of these. Okay, so use read underscore CSV. Okay, and then I just delete the first column. Okay, the first column is about the date, but I just deleted it. So I use this, okay, dot followed by the square bracket and -1. Okay, just delete the first column, and then you will see the result is something like this. Okay, 0050, 0056, and 006205, 00646. And you can see down here we have the price of the 4 ETF. Okay. Okay, so if we have the price of these 4 ETFs, then we can calculate the. Okay, we can calculate the GMVP. Okay, so for in this case, we can calculate the GMVP here. Okay, so minimum variance portfolio. Okay. Down here, we can calculate the covariance. Okay, we can calculate the return of the 4 ETFs, and then we can calculate the covariance and means of the 4 ETF. Okay, so this is about the first way to import data, and the second way is to use the return calculate. You return.calculate, and we can convert it into metrics. Okay, so it's very similar to the first method. So You can use either one, or maybe you can use your own way to import the data. So it's very flexible. Okay, I provide the codings here is just a reference. You can use this as a reference. Okay, the only thing is that you can import the data and do some calculation. I think that's enough. Okay, so I'm not requiring you to follow the codings here, because there are so many approaches to import the data into R. Okay, so this is just for your reference. And then after you import the data, then you can answer the question 1, because question 1 is very similar, because you can just, what we are doing here is to find the MVP, okay, MVP of the portfolio. So you can see here, okay, so let's just okay, now you can see the MVP here. The global MVP here is for the 4 assets is as follows. You can see we have 0, 0, 0, 50. The weightings is negative. Okay, but for the other 3 ETFs, we have positive weightings. Okay, so this is based on the daily data. Okay. And then you can also calculate the return of the MVP. So let's calculate the return of the MVP here. And also the sigma here. Okay, so you can see this sigma. Okay, so let's take a break. Okay, then we will be back later.